Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PepsiCo Inc. annual report. PepsiCo Inc. offers a diverse range of businesses and services across the globe. At its core, the company provides beverages and convenient foods through various segments. These include dips, cheese-flavored snacks, and spreads, cereals, rice, pasta, mixes, and syrups, beverage concentrates, fountain syrups and finished goods, ready-to-drink tea, coffee, and juices, dairy products, and sparkling water makers. The company operates under numerous brands, including Lay's, Doritos, Pepsi-Cola, Gatorade, Mountain Dew, Quaker, Aquafina, Bubbly, Emperador, and many others. These brands cater to various markets, from wholesale and food service customers to grocery stores, convenience stores, and e-commerce retailers. In addition to its product offerings, PepsiCo also provides distribution services through a network of direct store delivery, customer warehouse, and distributor networks. The company serves a wide range of customers, including authorized independent bottlers, hard discounters, membership stores, and mass merchandisers. With a presence in over 200 countries, PepsiCo is a leading player in the global food and beverage industry. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause a stock price to increase. The stock price of a company like PepsiCo Inc. can be influenced by various factors that contribute to its overall performance and growth. One key factor is the company's financial health, including revenue growth, profitability, and cash flow. When a company reports strong earnings and revenue growth, it can lead to an increase in investor confidence, causing the stock price to rise. Another significant factor is the company's strategic decisions and initiatives that drive innovation and expansion. For instance, PepsiCo's investments in digital marketing, e-commerce, and sustainability efforts may enhance its brand value and appeal to a wider audience, leading to increased demand for its products and subsequently driving up the stock price. Additionally, changes in consumer behavior and preferences can also impact a company's stock price. If consumers are shifting towards healthier or more sustainable options, PepsiCo's ability to adapt and innovate in response to these trends may lead to an increase in sales and revenue, causing the stock price to rise. Furthermore, external factors such as economic growth, interest rates, and industry trends can also influence a company's stock price. A strong economy with low unemployment and rising consumer spending can boost demand for PepsiCo's products, leading to increased sales and revenue. Lastly, investor sentiment and market expectations play a crucial role in determining a company's stock price. When investors become optimistic about a company's future prospects, they may drive up the stock price through buying activity, causing it to increase over time. The primary drivers of revenue growth or decline can be categorized into several key areas. On the positive side, sales incentives and discounts, advertising and marketing activities, and concentration of credit risk from major customers have contributed to an increase in revenue. Conversely, restructuring and impairment charges, asset impairments due to plant closures, and decrease in brands due to impairments or sales have led to a decline in revenue. The cost of sales has also been affected by commodity price fluctuations and foreign exchange contracts. Additionally, selling, general, and administrative expenses have been influenced by advertising and marketing activities, as well as distribution costs. Research and development costs have also been impacted by various factors. Furthermore, the company's goodwill and intangible assets have been subject to a qualitative assessment, taking into account macroeconomic conditions, industry and competitive conditions, legal and regulatory environment, historical financial performance, and significant changes in the brand or reporting unit. Transactions such as acquisitions and sales of certain brands or assets have also had an impact on revenue growth or decline. Overall, these factors demonstrate that revenue growth or decline is influenced by a combination of internal and external factors, including business strategies, market conditions, and regulatory environments. The net income of the company experienced a significant decline in 2025 compared to the previous year. The net income decreased by 14% to $8,240 million from $9,578 million in 2024. This represents a decrease of $1,338 million from 2024 to 2025. The profit margins also underwent a change in 2025. The operating margin decreased by 1.8 percentage points to 12.2% from 14% in 2024. However, the core, non-GAAP operating profit margin showed an improvement, increasing to 26.6%. On the other hand, the gross profit margin remained relatively stable at 54.2% and 54.7% for 2025 and 2024 respectively. The decrease in net income can be attributed to various factors, including changes in revenue, expenses, or operating efficiency. The decline in operating margin suggests that the company may have experienced increased costs or decreased sales. However, the improvement in core, non-GAAP operating profit margin indicates that the company's underlying profitability has improved. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided information, the net cash provided by operating activities for the year 2025 was a substantial $12,087 million. This figure indicates that the company has successfully managed its operations and generated sufficient cash to cover its expenses. Furthermore, on page 63, it is stated that the operating cash flow for 2025 was $651 million. While this figure may seem lower than the net cash provided by operating activities, it still represents a positive increase in cash and cash equivalents. This suggests that the company's operations are generating sufficient cash to meet its financial obligations and invest in growth opportunities. In conclusion, the company is indeed generating positive operating cash flow, as evidenced by both the net cash provided by operating activities and the operating cash flow figures for 2025. This is a strong indicator of the company's financial health and ability to sustain its operations over time. The company's debt level has undergone significant changes over the past period. Initially, there was a notable increase in debt levels, with a rise of $1.5 billion from $2.9 billion to $4.4 billion on page 40. This trend continued as long-term debt obligations increased from $37,224 million to $42,321 million on pages 64 and 97. Furthermore, non-derivative debt instruments also saw an increase from $2.9 billion to $4.4 billion on page 101. In contrast, interest expenses have shown a slight decrease. On page 47, net interest expense, GAAP, decreased by 3% from $37,368 to $36,243. Additionally, the company's variable rate debt decreased from 13% to 11%, which contributed to a significant change in interest expenses on page 100. However, interest paid increased from $1,585 to $1,748 on page 113, indicating that while overall interest expenses have decreased slightly, there are still fluctuations in this area. The performance of various segments and regions in the market has been mixed. On a positive note, Russia, International Beverage, IB, Pacific Food and Beverage Americas, PFNA, and Europe, Middle East, Africa, EMEA, have all performed well. These regions have shown growth and stability, contributing positively to the overall market. On the other hand, some segments have struggled. Mexico has underperformed due to a decline in the Mexican peso, affecting its economic stability. Similarly, LATAM Foods and Pacific Foods have also experienced poor performance, indicating challenges in these markets. The management of the company is optimistic about its future outlook. The key driver behind this optimism is the implementation of a comprehensive strategy aimed at simplifying processes, re-engineering systems, and optimizing operations through various initiatives, such as the 2019 Multi-Year Productivity Plan. One of the primary focuses of the company's strategy is to invest in technology to improve operational efficiency and reduce costs. This is being achieved through the Global Business Transformation Initiative, which involves the implementation of enterprise resource planning, ERP, systems throughout its businesses in phases over the next several years. The company is also shifting towards shared business models across operations to simplify, harmonize, and automate processes. Additionally, it has made significant acquisitions, including Poppy and Sciat, which are expected to contribute to future growth. Furthermore, the management is committed to managing market risks through various strategies, including productivity initiatives and hedging. The company also expects to continue reinvesting $12 billion of earnings outside the U.S. for the foreseeable future, and is evaluating opportunities to reduce its annual tax rate through favorable resolution of tax issues. Overall, the company's strategy appears to be focused on driving growth through simplification, optimization, investment in technology, risk management, and strategic acquisitions. The company has made several significant acquisitions in recent years, expanding its portfolio and presence in the market. The most notable acquisitions include Poppi, a beverage company acquired for $1.95 billion, and Garza Food Ventures LLC, Sciot, a food company acquired for $1.2 billion. Additionally, the company acquired Celsius Transaction in 2025, Alani Nu brand in 2024, Sabra in 2024, Sciot in 2025, and Poppi again in 2024. In contrast to its acquisition strategy, the company has made only one notable divestiture, which is the sale of the Rockstar brand. This move suggests that the company is focusing on strategic acquisitions that align with its business goals, rather than holding onto brands that may not be core to its operations. Overall, these transactions demonstrate the company's commitment to growth and expansion through targeted investments in new businesses and brands. The company has a long history of rewarding its shareholders through both dividend payments and share buybacks. Since 1965, the company has paid consecutive quarterly cash dividends, demonstrating its commitment to returning value to its investors. In recent years, the company has continued this trend, with expected dividend payments totaling approximately $7.9 billion in 2026. In addition to paying dividends, the company has also been actively buying back shares. During the fourth quarter of 2025, the company repurchased a total of 1,600,000 shares for an approximate dollar value of $5.5 billion. This is part of the company's broader strategy to return value to its shareholders, with a total of $8.6 billion returned in 2025 alone. Overall, the company's history and recent actions demonstrate a clear commitment to rewarding its shareholders through both dividend payments and share buybacks. Concerns about inventory buildup or supply chain disruption are prevalent in the extracted summaries. Various factors contribute to these concerns, including water scarcity, manufacturing operations disruptions, raw material and supply price volatility, fluctuations in availability, potential disruptions to manufacturing and sourcing of products or materials, tariffs and trade restrictions, geopolitical events and tensions, demonstrations and protests, governmental actions, economic, political, and social conditions in developing and emerging markets, nationalization of assets or closure of operations, restrictions on import or export of products or ingredients, highly inflationary economies, devaluation or fluctuation of currency, climate change, measures to address climate change, strikes or work stoppages, manufacturing and distribution impairments due to inability to renew or enter into new collective bargaining agreements, product supply interruptions due to strikes, work stoppages, or other business interruptions. These concerns are evident across multiple pages, including 14, 15, 16, 19, 20, 33, 35, and 36. The potential for inventory buildup or supply chain disruption is significant, with various factors contributing to these risks. For instance, page 14 highlights the impact of water scarcity on manufacturing operations, while page 15 notes the volatility in raw material and supply prices. Page 16 emphasizes the role of geopolitical events and tensions in disrupting global markets and supply chains. Furthermore, pages 19 and 20 discuss the potential for third-party service providers to fail to meet contractual obligations, leading to business disruption and systems disruptions. Climate change is also identified as a risk factor on page 19, with extreme weather conditions potentially disrupting agricultural production, impairing production capabilities, and disrupting supply chain operations. The ongoing nature of these concerns is evident in pages 33 and 35, which highlight the need for further innovation and collaboration in supply chain management to address persistent disruptions. Page 36 notes the impact of tariffs on supply chain constraints and inflationary impacts, while page 70 discusses the financial implications of inventory buildup or supply chain disruption. Overall, the extracted summary suggests that concerns about inventory buildup or supply chain disruption are widespread and multifaceted, with various factors contributing to these risks. That concludes the financial summary for PepsiCo, Inc. Feel free to comment below, and I will be happy to answer them when possible.